I've said many times, Vlad, 90% of the move in the last 10% of the time. And been saying that for years. And I also went back and looked at the actual arithmetic in 1980. And I forget the exact numbers, but it was like 87% of the move came in the last 8% of the time. That's just a rule of thumb. What it really means is there's a big move up in price in a short duration. So if you look at a 25-year bull market, 10% is 2.5 years. Gold broke out at around the 2000 level. So we might have a year and a half left, basis that metric. Well, what happens next? So we'll peak in a parabolic function like we just did in silver. Some people are saying that is it. That's the move, and you missed it. I don't think so, but, I'm not 100% certain. We have had, well, first of all, we're in a very strong secular bull market. And as far as I can determine, we're in the final phase, which means we get the most acceleration in price in a rather short period of time. And so that's number one to bear in mind. Number two is in these times and a major bull market at the end of the cycle, we see drastic moves up and down. And this is the function of a bull market, is to shake off, scare out as many people riding that bull market as possible. And we saw that recently. Just for context, we had a very good market in 2025 for gold, silver, platinum, and palladium. All four moving together is confirmation of a major bull market. We saw silver and platinum actually lag up until April or so of 2025, and then they took off and exceeded gold's move rather substantially. So both platinum and silver were up 140% for the year. Silver went what I would call double parabolic in January, up almost 70% for the month. And that was scaring me, Vlad. Not that I don't like to see it, and my account looked pretty good, but you don't count your chickens until they're hatched. And I was warning everyone, public and private, my private work as well as interviews like this, that it was going to come down. And it's probably going to come down hard. And it did. And of course, many people are mistakenly saying that this was the largest one-day sell-off in the silver market ever, which is not true. If you go back into history, and I was there, I was a young enough man at the time, so my age now. Point is, Silver Thursday, March 27, 1980, silver went from almost $21 an ounce to about 10. So it was like a 50% cut rather than a 30% cut.
The year 2025 delivered rare, synchronized strength across gold, silver, platinum, and palladium, a clear confirmation of broad-based bullish momentum. Silver and platinum lagged initially, then erupted higher in the spring, ultimately outperforming gold. Silver even slipped into a near-parabolic advance early in the year, rising at a pace that has historically signaled overheating conditions. While headlines portray the subsequent sell-off as unprecedented, history offers a different perspective. In March 1980, silver suffered a far steeper single-day collapse in the aftermath of the Hunt brothers' squeeze. Context matters. Corrections, even violent ones, are not anomalies. They are a defining feature of every major metal cycle.
Nonetheless, that big move from like the 120, 124, whatever the top tick was, down to 78, I believe, that day, definitely shook out the market. But that's to be expected, unfortunately, especially when you get an acceleration. What's ironic about it, Vlad, is if you took the first day of 2026, which I think was the 2nd of January, and the day of the 30th, where it ended at, I think, 78, the market for January was still up 10% for the month, which is crazy. Because if I had told you ahead of time, hey, look, Vlad, I'm going to end January with another 10% gain in your silver price, say, oh, wow, great. But since it really just went, rocketed up. So there's point number two. Point number three, probably as important as point number one, is this. We are in a situation, we meaning precious metals investors, or the silver market, you can think of it in those terms, is in a new dynamic. The new dynamic is price discovery based upon physical demand. And that's what's been driving the price for the last several months, up until we saw this big sell off on January 30th, where the paper paradigm took over control of the market, and I'll put in quotation marks temporarily. So now we're kind of in a battle between physical demand for silver on the commercial bar side versus the paper quantities on the commercial bar side. And right now, the paper people are winning. And I think that's going to go back and forth a few times. The only caveat is I could be wrong. I doubt it, but we could be in a situation where the physical demand for hard metal commercial bars has been satisfied temporarily.
A critical shift has taken shape in recent months. Price discovery is increasingly being driven by physical demand rather than by paper trading alone. Industrial consumers, from solar manufacturers to electric vehicle producers, have been competing aggressively for commercial bar supply. Yet periodic sell-offs underscore the continuing influence of futures markets and algorithmic trading systems. When leveraged paper contracts dominate trading volume, they can temporarily overwhelm underlying physical fundamentals. This tug-of-war between tangible metal demand and derivative positioning may come to define the current cycle. If industrial buyers step back after securing inventory, momentum could cool. But should supply tighten again, physical demand may reassert decisive control over pricing.
So for an example, Vlad, let's just say that Samsung, 3M, Tesla have all got their hands on enough physical silver to satisfy their personal demand for industry for the next 6 months, 6 years, whatever their timeline is. And they don't want to buy anymore right now. They've got it locked in, and that demand is gone away. Now, I really, really doubt that. But if that is the case, then we're going to have to rest a while before that demand comes back. Now, that doesn't negate investment demand, which could take over and continue this bull market based on physical supply. But it might not, because most of the investment demand is price-based, meaning I'm only going to buy silver when it does. And there's all kinds of algorithms out there, but until it gets above the 10-day moving average, 20-day moving average converted by the 10-day moving average, and the volume is at this level, then we'll go in and buy. I don't want to get too technical here. Overall, I'm still bullish. I think we've done enough damage, or if you want to call it damage if you're long, to have to rest a while, probably establish a trading range, and then determine if the physical market, as I just said, is gaining control again, and we start marching up again. I've said many times, Vlad, 90% of the movement in the last 10% of the time. And I been saying that for years. And I also went back and looked at the actual arithmetic in 1980. And I forget the exact numbers, but it was like 87% of the move came in the last 8% of the time. But it's just a rule of thumb. What it really means is there's a big move up in price in a short duration. So if you look at a 25-year bull market, 10% is 2.5 years. Gold broke out at around the 2000 level. So we might have a year and a half left, basis that metric. Well, what happens next? So we'll peak in a parabolic function like we just did in silver. Some people are saying that is it. That's the move, and you missed it. I don't think so, but, I'm not 100% certain.
Market history shows that the bulk of gains in a prolonged bull market often arrives in its final stretch. In both 1980 and 2011, silver's most dramatic advances occurred just before abrupt reversals. Parabolic moves inevitably produce overbought, overextended, and temporarily inflated conditions. Once enthusiasm crests, gravity reasserts itself. Prices typically retreat toward a new equilibrium, well above prior breakout levels, but below the euphoric peak. What distinguishes the current environment from past cycles is the backdrop: higher mining costs, rising energy prices, and structurally stronger industrial demand. Together, these forces may anchor a higher fair value floor once the eventual peak is set.
Especially basis the gold trade. Anyway, what does happen? Well, what's occurred in almost all cases that I'm aware of is that it peaks in a parabolic move. Some very few get out the top. The market starts down and then it corrects down. So it gets overbought, overextended, and really overvalued. And when it's overvalued, overbought, and overextended, it has to correct. And it comes back to being fair priced. And then it establishes a range at the fair price level. And you see people that are disappointed, they missed the top, but it's still much higher than it was from the breakout, like you just outlined for silver. That's what normally happens. Now, in silver, the last time we got it overbought, overextended in a major way was in 1980. It happened again in 2011. And in both cases, it dropped. In 2011, it dropped to a new high, $30 range, stayed there for about a year, and then it folded and came way down. I think this time it'll act more like gold, what I just outlined. It'll drop and establish a new fair value price. I don't think it will do what it did in 1980 or 2011, where it really crashes over time. First of all, the cost to mine it will be higher. At that time, I expect oil costs or oil price to be substantially greater than it is now. And lastly, this industrial demand is like 65% of the market. That's not going away. So I do think we'll see a reestablishment of quote unquote fairly valued gold and silver after.
Navigating a late-stage bull market demands discipline. Instead of trying to pinpoint the exact top, gradually scaling out during rallies helps reduce emotional decision-making. Liquidity conditions matter as well. During sharp price spikes, the gap between quoted spot prices and real-world dealer bids can widen significantly, making access to tight spreads especially important. Many investors who exited near peak levels did so by adhering to predefined plans rather than chasing momentum. The objective isn't perfection, it's preservation. Protecting gains while retaining partial exposure allows continued participation in any further upside without risking a full round trip back to original entry levels.
Too busy, not too. Actually, I called and I was on the phone to pull the trigger, and it was so hard to sell at the top because so few people were buying. But I did put an outline out to my paid members with a very concise, deliberate guidance to sell into the rally. Sell, for example, 20% at $80 silver, 20% at $90 silver, 20% above 100, hold 20% in case we go into hyperinflation. And then on the way down, if we establish a 10-day trading, average trading below this level, then sell more. Because the last thing you want to do is go from 50 to 120 and back to 50 if you got in at 50 and ride it all the way up and all the way back. So this guideline gives them. So I had 3 or 4, I'm sure it was more than that, because usually every email you get is like there's 10 people behind it with the same question. That's a rule of thumb, not an exact number. But I had about 4 that got out, and they got out in the hundreds. And it was very difficult to get out at that real price because most dealers were bidding back $15, $20, $25. But I interact with a hedge fund manager friend of mine that gives really fair prices on the spread, very low on the buy side and very low on the sell side. In other words, you're getting the best price by buying and you're getting the best price by selling. And I guide all of my members to that entity. Some use them, some don't. I'd say at least 90% of our membership uses them. And so they were able to escape that huge, delta, that huge difference between the spot price on your computer versus what they were actually paying. So that made me pretty happy because, I want people to get the best price of buying and selling. So that's something to note. Other than that, no. What did I do? Really nothing. I was going to lighten up on not just the silver, but my platinum position. I didn't. So I did not. Stock-wise, yes, but my stock portfolio is not even 50% of my overall holdings now at my age. And I'm long-term. I think most of the stocks did get maybe, I wouldn't say overvalued per se, but they made a nice run. And so I did take a little bit of profit there, but that wasn't at the time. It was prior to that. A friend of mine that's a very good stock analyst that works for me suggested maybe taking a little bit off the table. And at the time I thought, yeah, why not? We did. And looking from today, Vlad, I'm glad I did.
Mining equities often follow a different rhythm than the metals they produce. Even when bullion pulls back from peak levels, producers can continue to benefit from elevated average selling prices and widening margins. History offers clear parallels. During past cycles, including the consolidation that followed the 1980 peak, mining shares advanced even as gold stabilized below its highs. In the current environment, large producers with strong balance sheets and operational discipline are likely to prove more resilient than highly speculative junior miners, which tend to suffer outsized damage during liquidity shocks. As this cycle progresses, selectivity becomes increasingly important. The broader investment thesis remains intact, but leadership is unlikely to be static. Ultimately, disciplined positioning, not blanket exposure, will determine who prospers in the final chapters of this metals supercycle.
I think, well, Rick's a very smart guy, and I haven't spoke to him one-on-one in quite some time, but I did have him on my mastermind series a few years back, and I was actually not astounded, but um, a little involved as from how much we think alike. Because I focus on the blue chips. Certainly, we do speculations and mid tiers. We look at everything. We look at uranium. We look at lithium. We look at copper. Just like him, we look across the spectrum. We're not gold and silver only. Although that's where the bulk of our investments are currently, it's moved around sector to sector with more emphasis depending on the metal du jour, what's really popular and moving. Having said that, I really agree with him that the best value is in the mining shares and probably in the top tier currently. There's always value across the spectrum, but you got to be careful in the juniors because you get a washout like this, it harms them all. But you got a lot more liquidity in a major than you do in a junior. So I think he's on point. I know I learned that lesson the hard way. I'll just be brief, Vlad. But in 1980, when I sold most of my gold at 700, not the top at 850, I sold the mining shares roughly at the same time. Think, oh, gold's peaked, and the shares have peaked. And I did the one-handed salute, going, oh my goodness, 6 months later, what did I do? Because the average price, remember I said it goes up and it reconsolidates. From memory, I think it was around $600 gold was kind of the average for the next year or so. Well, the price of gold was hitting a new all-time high at $300 gold in December 1979. That's when I started my big, not big for me, my little, investment in futures, which for me was big for my age and, size of what I could invest. But anyway, the mining shares just kept going up and up because the earnings were so much greater than what they were the previous 2 quarters. So I left a lot of money on the table by not realizing that the earnings of these gold companies would go higher and higher and higher. Even though gold had gone up and come down, the new price still brought them a huge profit to the bottom line. So I've already talked about that in my newsletter to our members that hey, don't make the mistake that I did. And the stocks move on a different modality, different paradigm than the metal itself. So